the Federal Reserve raising interest rates. They went ahead and implemented 25 basis points. They are going to continue to do that. The forecast right now is for 6 additional rate hikes, kind of in that ballpark, quarter point, 25 basis points for each one of those through the end of this year. So, that's going to be nearly a 2% bump if they follow through from the beginning of the year to the end. So obviously they want to try to handle this on a gradual basis and not raise interest rates too quickly, but they also recognize that with inflation the way it is, they're going to need to act decisively to try to get this under control. So when you heard about that, what were your initial thoughts?
Well, at first, I want to remind everybody not to panic about it. We knew it was coming.
Sure.
They cut rates drastically before COVID, and they have to go up at some point. It is going to be a little bit more important as the months go on this year to see how the market responds to the third, the fourth, the fifth rate increase. First one, not really such a big issue. Rates have kind of jumped already, I think almost a percentage point in the past couple months. So the banks were anticipating this. They were raising their rates. We actually have told our listeners in some previous podcasts, get ready for this to start to happen.
Right.
But this is the first step. It's an incremental step, right? In the next 6, you say, or so.
Yeah. So, ultimately they're forecasting where they expect to take things. Now, obviously, nobody can know exactly what's going to happen in the future because a lot of things that might impact those decisions haven't happened yet, but they are coming. So ultimately, though, I think the most important thing is that they're communicating a willingness now to actually try to do something to get inflation under control. The numbers on inflation continue to be alarming. I mean, it's amazing how it seems like a week of the news cycle and people already have assimilated the information and they just move on and it no longer provides any sort of shock value. But if you step back and think about what does 8% annualized inflation really mean, and as we touched upon in our last episode, that number is still accelerating. And based on what I've seen from producer prices and some of these other reports that are following, I think we can expect that inflation is going to continue to accelerate further over the next couple of months. So I think the Fed is finally saying, look, this is a serious enough event that we have to do something. We don't want necessarily to do something. Government spending is still going to continue to be very high. And there's so much uncertainty right now with the situation in Ukraine. I mean, Russia has basically had a much harder time of this than most folks expected they would, and probably more so than they expected they would. So that being the case, under ordinary times, if there wasn't so much going on in the financial markets, I think the Fed would be looking at probably loosening policy a little bit just to relax the markets. Yeah. But for them in this environment to say, no, this is such a problem that we're going to tighten and we're probably going to incrementally do this over the next year. So it doesn't hopefully hurt too much, but the consequences are going to be what they're going to be. I think that sends a message that will hopefully bring a little bit of stability to folks when it comes to their expectations. You and I talk about this concept a lot on the show, but what we want to avoid is the emotional reaction to market volatility, whatever that volatility is, however it may manifest itself. So what the Fed is hopefully doing with their policy projections today is saying, okay, we want to bring a little bit of stability to the market by at least letting you know what to expect going forward. So often, people don't like to hear bad news, but they would rather have bad news than no news, or bad news than deceit.
Yeah.
Right? Because at least when there's bad news and it's reliable, you have a good expectation that it's going to happen, that gives you the ability to react.
Yep.
And that reduces uncertainty, which brings stability. So that's hopefully what we're going to see here. But from a practical standpoint, there are implications of rising interest rates. And I'm going to be interested to get your feedback on what you think those are. But I'm going to kick it off with credit cards, because any sort of revolving debt with variable interest rates, those rates are going to go up. And so as time moves on, you're going to see the value of your dollar continue to go down. And as interest rates go up, if you have this kind of debt that adjusts based on interest rates, the amount of debt you have to pay is going to go up. So when you look at having to pay more debt with less valuable dollars, that's just a recipe for disaster any way you cut it. So if you've got any sort of credit card debt or interest rate adjustable debt, you want to try to get out of that as soon as reasonably possible. So with that, I'm going to kick it over to you, Saki. What do you see happening here? What do you think is good advice?
So the number one implication of this is exactly what you said: variable interest rate debt, whether it's an adjustable rate mortgage or some other loan or credit card debt. So my advice is actually going to, for the past 3 years ish, give or take, we've been in a growth mode in our society. We have Gen Z coming up into the investing world where they're adults now, and they don't really have a long track record. Younger millennials don't have a long track record. So all they really know is growth. I'm going to throw my money in somewhere and it's going to make money very quickly. And that's not historically accurate. That's not usually the results you get historically. So I'm actually going to change gears here. I'm going to recommend to our listeners that if you have variable debt, get out of growth mode, whatever that looks like for you, whether it's your stocks, whether it's your, cryptocurrency, real estate, produce, whatever you're buying, get out of growth mode and get rid of any variable debt. Don't panic to get rid of it, but systematically create a plan to get rid of your variable debt. You have time, right? You're not being affected too much yet. But if you continue to have that debt come October, November, or next spring, because more than likely they're going to go up 5-6 more times this year, they're probably going to go up some more next year as well. So my recommendation is shift out of growth mode, work on the balance sheet a little bit, whether you're a person for your individual self or a business, and get rid of that variable debt if you have it.
Yeah, I think that's good advice. And I think to the extent that you can, try to do it with a sense of urgency that's a little different from panic, right? Panic is just impulsive. Oh, I'm on a sinking ship. Let me jump in the water, right?
Yeah.
You want to get a game plan. You have choices, you have options. Lay those out, choose what's best for you, but don't don't put it off either, right? Because a lot of people are going to be moving from where they are to where they think they should be. So you're going to see people moving into what are going to be considered safer areas in the investment markets, things that are going to hopefully be able to weather whatever storms might be on the horizon. Well, every day that you wait, more and more people are going to be trying to make the same decisions that you're making, which is going to drive the cost of making that decision up.
The Purposeful Podcast.